Buying a home is one of the most exciting things that you can do as an adult. It usually means that you've made it and you've achieved the American dream. But what you may not realize is if you just continue paying your mortgage on a regular basis, that you'll end up paying over 2 times the amount that you borrowed back to the bank. So in today's video, I'm going to be showing you 3 simple ways to help you pay off your mortgage faster that will save you tens of thousands of dollars over the lifetime of the loan. And this video is dedicated to those who want to be debt-free by the time they're 50 years old and own their home free and clear. These tactics work because of how mortgages are structured. So how exactly does a mortgage work? A mortgage is normally a 30-year loan that you use to help you buy a property. You would come in with 20% for the down payment, and a bank or other financial institution would come in for the other 80%. And they'll tell you that you can pay off this loan over 30 years plus any interest. But because it's pretty complicated to make payments that change every single month based on how much principal and interest you have to pay, they simplified it and structured it so that your principal and interest payments change every single month, but the total payment that you make is fixed. This way you're paying the same amount every single month for 30 years, but the amount of principal you're paying back and the amount of interest that you're paying changes over time. Every month when you pay your mortgage, your principal balance that you owe to the bank goes down, and so does the total interest that you also owe. When you're first making your mortgage payments, around 70% of your payment is actually going to be going towards the interest, and only 30% of that payment is going to the bank to pay down your principal. So by using the tips that I'll be sharing with you in this video, you'll learn how to lower your overall payment to the bank and will dramatically shorten the time frame as well. So instead of a 30-year loan, you might end up paying your loan off in 20 plus years instead. With interest rates in the 6s and the 7s, it's more important than ever to learn how to pay less interest to the bank. Now, the first way to dramatically lower your interest is by making extra payments to the principal. Now, I know what you guys may be thinking. Sean, you said you're gonna be showing us ways to lower our overall payment, but now you're telling us to pay extra? Well, hear me out first. Imagine you're a busy person. You go out and you buy a cup of coffee every single morning before going to work. And let's just say that cup of coffee costs you $5. You don't really think too much about it, right? A $5 cup every day, every single day for 5 days out of the week is going to be $25 a week or $100 a month. Most people won't miss $100 a month, but if you actually put that $100 a month into your home to pay off your principal faster, you'll end up saving $75,000. Now, would you rather have a cup of coffee every day or $75,000? Let me know your thoughts down in the comment section below. So how does this work exactly? Well, like I mentioned earlier, the way that mortgages are structured is that in the very beginning, most of your payments are going towards the interest. So if you just make small, extra principal payments in the beginning, then you're gonna chunk down your loan a lot faster than you're supposed to, which will lower your total interest payments. When I first bought my primary home in the Bay Area, my total payments for my mortgage plus my escrow payments for the insurance ended up being around $1,800 a month. And I thought, well, what would happen if I just rounded that up and paid $2,000 a month? Personally, I was gonna miss the extra $200 a month, and I wanted to see how far that would take my money. I did the calculations, and guess what? If I just continued along that path of paying an extra $200 a month, then my loan would be finished in 24.5 years instead of 30, and I'll have saved over $46,000 over the loan. Now, the total amount that you're gonna be saving is gonna vary based on how big your loan is and what interest rate you have on your mortgage. Another beauty of doing that is it actually trained my brain to save a little more every single month. And also, if times were tough, I could always scale that back and continue making just my regular payments of $1,800 a month. Also, don't forget, when you're doing this, you're not actually paying more money, you're just paying it back to the bank a little bit earlier than you have to. So let's do an example together. I like to go on this website hosted by Dave Ramsey for his mortgage payoff calculator. And all you have to do is fill in the original loan amount, date of first payment, your loan length, and interest rate. So in this scenario, let's talk about a $500,000 loan. Our first payment is January 1st of 2023, and it's a 30-year loan, and our interest rate is at 7%. So you see our current monthly payment is $3,326.51. Now, if you did nothing, you'd be paying $697,000 in interest, which is a lot more than the $500,000 you borrowed. So your total payment is almost $1.2 million. So you see, interest rates make a very big difference here. But what would happen if we paid just $100 a month extra? And we started it back when we first started the loan. Calculate results. And we see that you're gonna save over $75,000 and you're shortening your time frame from 30 years down to 27 years and 4 months. Now, setting this up is very easy. All you have to do is go to your bank or your lender and tell them that you want to make extra principal payments. You write down how much money you're going to be sending every single month, and they'll automatically do it for you. And it's very standard and very easy to set up. Now, for those of you who think that that's a lot of money, think about this. $100 a month divided by 30 days is $3 a day. I think most people out there can find or spare $3 a day, knowing that it can save them this much money over the lifetime of the loan. Now, this was a very effective way of paying off your mortgage faster. But another very helpful strategy of paying off your mortgage faster is by switching to bi-weekly payments. Now, this strategy is very similar to the first one that I mentioned, but instead of making one big payment every single month, you're gonna split your payments into two, and you're gonna be making 2 half payments every other week. And you might be thinking, Sean, that sounds like the exact same thing. You're making 2 half payments every other week isn't the same as making 1 full payment every single month. Well, it's actually not. Since there are actually 52 weeks in a year, you're gonna end up making 26 half payments over that time, which ends up being 13 months worth of payments instead of 12 months. And so essentially, you're making a whole additional months of payments directly towards the principal every single year. This method actually has you contributing way more to your mortgage than just $100 a month. But since most people are paid on a bi-weekly schedule anyways, it makes it convenient to sync up your paychecks with your bi-weekly mortgage payments. So if we go back to our example here, let's say you're making an extra monthly payment of $3326.51, and you make it once a year. So yearly, you're paying this much extra. Let's see how that changes our loan amount. You end up saving $177,000, and you reduce your time frame by over 6 years. This is pretty insane, but of course it is a relatively aggressive way to pay off your loan. Now, by syncing up your mortgage payments with your paychecks, it's actually kind of nice because now you don't have to worry about saving and having to hold on to money to make a big mortgage payment at the beginning of your month. Now, these two methods that we went over were pretty similar. Essentially, you're just making extra principal payments. One is just on your own schedule, and the other one is by syncing it with your payment schedule from work. But the third one is just a straight shot way of saving money, and that's by refinancing into a lower interest rate. Now, if you were fortunate enough to buy a home when interest rates were in the 3 or 4%, then this may not apply to you for some time, but rates are now hovering in the 6 to 7% range. However, if interest rates drop by even 1%, then refinancing your mortgage can be a great way to save money. The interest rate is really what makes you end up paying a lot more for your mortgage. As we showed in our original example, your original loan amount was for $500,000, but your total interest is for $697,000, which means that you're paying almost $1.2 million just to borrow this money. It's pretty insane. So if you can lower the interest rate, then of course you're going to be in a better position and you're going to be able to save more money naturally because you just owe the bank less money. Now, there's nothing that you can really do about controlling the interest rates because that moves with the market. But let's say that you get into a home and you get it with a 7% mortgage. If down the line, the rates drop by just 1%, oftentimes you can go back to any lender and ask them to refinance your loan into a lower interest rate without needing to pay for anything. So how does this work? Essentially, the same lender or a new lender will come in and redo your loan. So if you already had an existing loan at $300,000, they'll pay it off with a new $300,000 loan with different terms. And during that time, everything can change. You could potentially get a larger loan than you had before, and you can just pocket the difference. That's called a cash out refinance. Or you could have just the exact same loan amount and then the terms change, so your interest rate changes. Now, the cool thing about refinancing into a lower interest rate is that usually these are done for free. Okay, it's not really free, but you won't have to pay any out-of-pocket costs. And that's because a lender is able to give you a loan with a slightly higher interest rate than what they could normally give you, and then cover all of your closing costs associated with that refinance. So let's show an example here. If we edit our original loan and we save this number here, 3326.51, and then change this rate to 6.125 because we're refinancing it and we're paying no money out of pocket, then your new mortgage is gonna be 3038.05. So if we subtract 3326.51 from this new number, then we're actually saving $288 every single month. But if we actually put this number back into our mortgage and pay the same amount with a lower interest rate on a monthly basis, you can see that you're saving $141,000 and you're saving 6 years and 1 month. So by lowering your interest rate and continuing to make the same payment you were before, you're gonna be saving a lot of money with interest. Now the question is this worth it? Now this strategy is relatively simple as long as you can qualify for a new loan. So if you haven't been working, or if you're retired, got laid off, if you have bad credit score, then this option may not be for you. Another thing that you need to consider is if you bought the home originally as an owner occupied and now you moved out and it's a rental. Because when you refinance, they're gonna look at the property and say, oh, it's a rental property, which usually means higher interest rates. But if everything is the same, then refinancing to a lower interest rate is clearly just beneficial to you because again, you have to pay for nothing out of pocket and you drop your interest rate. So now that you got this far, you may be thinking, is it worth it to dramatically reduce my mortgage payments and pay off my house early if I want to be an investor? Since some people have very low interest rates, they may think that the money is better used elsewhere instead of aggressively paying down their low interest rate mortgage. We can definitely go on a debate on that in another video. But the way I see it is that if you want to live a calm and quiet life and you don't want to have any debt, then yes, this is definitely worth doing and it's definitely worth aggressively paying off your mortgage. And the cool thing is, once you put the money in, it compounds and lasts for a very long time. So even if you only made extra principal payments for the first 5 years and then stopped, you're already going to be saving a lot of money. So I personally think it's always worth it to put in a couple of $100s at the very beginning of your loan because of how compound interest works. You can dramatically pay down some extra principal from the very beginning, and then it will carry you for the rest of your loan. Now, if you guys want to start investing in real estate, then check out this video here about how you can analyze a rental property. Thanks for watching, and I'll see you next time. Take care.